So much for tuning in to Talking Point. I'm your host, Niraj Shah, and the Talking Point today are the views of our guest, Mr. Nilesh Shah of Kotak AMC. Needs no introduction. And while you heard him often, it's been a while that he's been on our platform, so it's a pleasure to have him today. Mr. Shah, thank you so much for taking the time out and speaking to us today. Good morning, and I hope all is safe.
Thank you, Neeraj. Everything is safe at our end. I hope and pray everything is fine at your end and the viewers' end.
Yeah, same here, same here. I was just smiling before the interview because I was recollecting an event that we did, Mr. Shah, some 4, 5, 6 years back. I don't remember. I was not in BloombergQuint then, but we had met at a hall of a local gym in Ghatkopar area of Mumbai. And the way the hall was packed, who would have thought that 5 years out, if we want to do such an event, it will be virtually impossible to have a room of 300 people packed to the brim with 500 people and do a really good event. Things have just changed so much. But be that as it may, let's focus on the markets. What's your sense, Mr. Shah? I want to start off one with the global picture and then the local picture. On the global front, is volatility the order of the day, or do you believe volatility accompanied with maybe some valuation corrections or sentiment getting spoiled because of higher rates could be the order of the day?
So we are in an unprecedented world where markets are assuming that there is a central bank put. There is liquidity printed every time there is some sort of slowdown in an economy. Interest rates are cut to the bottom, and various interventions are done by the central banks around the world in various markets. Now, when I look at listed equity on historical basis, it does look like that globally it's trading at slightly higher valuation. Market cap to GDP ratio, which was generally below 100, is now generally above 100. But then when I look at cryptocurrencies, NFT, venture capital, private equity deals, on their relative valuation, listed equity market looks like a steal. So we are in an unprecedented world where liquidity, interest rates, and intervention is creating probably a false, but yet an assurance that there is central bank put on the markets.
Yeah, well, that is most certainly true. Central banks were probably the first. The liquidity was probably the first vaccine that we all received if you are a financial market investor. BofA did this very interesting survey, Mr. Shah, and some part of that survey, I just wanted your view on a couple of the points that they have made. So, of all the fund managers they interviewed around, COVID has ceased to be the biggest risk for the markets. And higher growth and higher inflation is now a consensus. So the question to you is, do you perceive as well that COVID per se will not have a big impact on markets, even if we are in a second wave or a third wave, because financial markets and the world at large has learned to live with it, even if the mortality rate might be a bit higher at certain times?
So the Neeraj, by limitation of surveys upon the recipient answering the question. We are all fund managers based in Mumbai. If outside of our window we see rain coming, we assume monsoon is normal. And if someone does a survey on us whether monsoon is normal or not, the answer is more dependent upon what I see outside of my window rather than what is the fact. Now, in developed market, undoubtedly, because of vaccination, few countries, not all, just few countries are in a position to say that now COVID-19 is no longer the biggest risk. However, we all know how premature it is to declare victory on COVID-19. In December, Feb 2021, we were seeing dramatic drop in COVID-19 cases, and in April, May, the situation quickly reversed. There are also countries like Chile and Seychelles where despite vaccination, COVID-19 has resurged. So I will say that while you can change priorities of the risk, growth, inflation, you'll really have to keep an eye for some time on COVID-19 I hope and pray that COVID-19 doesn't resurface with vaccination. But will I take my eyes off that? Answer is no.
I get your point. Okay, then actually tied to that, I have another question. Let me ask that you. It's a bit domestic in nature, but then I also want your view on the yields and the higher growth forecast. But just before that, since you mentioned this, India is now as much a retail money dominated market as probably it was maybe 10 years ago, dominated by virtue of what the FIs would be doing. So by virtue of the mutual fund industry and retail money coming into the mutual fund route or through the direct route as well now is well known. Do you reckon therefore for India, until the COVID scare completely goes away, higher participation may not happen? And conversely, actually, my second part of my question is, do you believe that in India, higher participation is still ahead? Because if we manage to defeat the COVID scare, then maybe the retail money which is coming in might actually come in bigger dollops going ahead.
So, Neeraj, retail behavior in a country like India is very difficult to compartmentalize. We all know how in March 2020 till almost September 2020, retail Indians were buyers, how record demat accounts were opened, and how they were going directly into stock. However, if you see the data of October to December 2020 quarter, retail investors have actually sold equity and brought down their equity holding in listed companies. Now, this trend was partly seen in mutual funds where somewhere around June, July 2020, if my memory serves me correctly, we started seeing redemption. And we only saw subscriptions coming back to equity mutual funds in March 21 after the first correction. So my feeling is that we have a heterogeneous group of retail investors. There is one set of HNIs and more experienced investors who continue to invest in equity market through ups and downs. There is a set of investors who enter direct equity or equity mutual funds only when they see past performance. And there is a set of investors who are inexperienced, and as their savings increase, they start taking a call in equity mutual funds through the advice of financial planners or mutual fund distributors, or they venture into direct equity. Now, all these three segments are driven by different objectives. And while their collective output, we call it as retail, but in reality, there are three sets of retail investors who are moving in or out of the market.
Yeah, okay. So, okay. Thanks for that answer. And maybe therefore it's difficult to quite figure out, get a complete handle on how it will shape up. But like I said, I just want to get done with the global conversation for a minute before we get to the local conversation. Again, because it was a global fund manager survey and they're looking at that side of the market, but because it has some bearing, the common belief seems to be that higher growth and higher inflation is a certainty. Do you reckon that could spoil the party for equities, Mr. Shah, or do you believe that some bit of inflation might actually be good for equities?
So generally, in an inflationary environment which is rising but moderately rising, equity tend to outperform over a period of time. Now, we are now starting at valuations which are rich compared to historical average, but much more reasonable compared to alternates like NFTs and cryptos and unlisted equity. My feeling is that if sustenance of growth is given, then rising inflation is unlikely to impact equity on a permanent basis. Of course, on a day when inflation number prints higher, there could be correction. But eventually, people will believe that growth will give pricing power to the companies and they will be able to pass it on to consumers. And if growth sustains, then that will result into higher profit margin. So if I have to convert this into a very simple answer, any company which has the pricing power will benefit in rising inflation. Any company which does not have pricing power will get squeezed in inflation as their margins will be impacted.
How does one translate this into the investing parlance as well, Mr. Shah? Because a lot of companies, for example, which may not have pricing power, But because growth has been so low thus far, and because growth is an uptake, there is growth visible and valuations are reasonable. But at the other end are companies which might have pricing power. Growth might still be there for them, but the valuations are expensive. So what would you do in such a scenario, Mr. Shah?
So obviously you have to juggle multiple balls at the same time to figure out which is worthy investing company. But prima facie, we are looking right now at a couple of broad things. One, is this company getting market share from unorganized sector or not? If that happens, growth will be higher than historical averages. And today, we have seen that in various sectors, large listed companies having better access to finance and managerial capability is doing far better than unorganized sector, which does not have managerial capability or access to finance. The second thing is related to companies' own internal innovation. Many a times it is said that you have to cut your own successes. You have to reinvent yourself. Now, is the investee company of mine a dinosaur where tail is on fire and they will realize after 3-4 days? Or they are like cockroaches who can survive nuclear bomb? We need to be investing in companies which are reinventing itself. There is massive wave of disruption coming. If you are resting on your laurels, it's likely that you will become extinct. But if you cut your own success and reinvent yourself and use technology and disruption to, reincarnate yourself, you rise like phoenix from your own ashes, then that is the company to be investing into. The other thing is this pricing power. Now, generally, we have seen companies which have brands, they have pricing power. Companies which have moat, they have pricing power. Now, you put all these things together to arrive at a set of companies where you believe, on an average, they will have better pricing power to ride over the wave of inflation.
Okay. Okay, so that's the base characteristic of how you're looking at companies. Now, what about, you mentioned that one of the key factors is companies gaining market share from others as well. What about companies which are essentially not compete? I mean, I'm not talking purely about 100% export oriented companies, but companies which are not necessarily just gaining small amounts of market share, but also because of the China plus one narrative, are able to export some part or a large part of their capabilities because of this new quote unquote China plus one narrative. Have you thought through that, and does that appear very, very lucrative? Because it's not a government doing, etc. It's just something that's happening around the world currently.
Undoubtedly, Niraj, by the companies which can gain market share in local market as well as export market tend to do pretty well. And now there are tailwinds working in their favor. We saw that in chemical industry, where China was withdrawing from chemical market. We had the ability to create niche chemicals. We were emerging as a reliable supply to large multinational buyers. And then our chemical company started investing in expansion. And with the expanded capacity, they were able to attract global buyers. Over a period of last 4 or 5 years, most of the chemical stocks delivered fantastic return to the investors. Same trend we saw in contract manufacturing company. They first started by way of a supplier to the global brands for selling in India. Then they did horizontal expansion into other products. And eventually they went into vertical expansion by becoming global supplier. Now this story is just beginning like Y2K of technology in 2000. We believe there will be not exactly Foxconn size of companies, but Foxconn kind of companies which will become dominant suppliers of certain materials, certain items to global brands. And they can create good value over a period of time. This production linked incentive scheme is one very, very powerful thing. Many years ago, we had launched Textile Upgradation Fund, which provided concessional financing to promoters for setting up textile capacity. Most of the promoters, bearing few exceptions, took the money, gold-plated the plant, siphoned off the money, and created NPA. And thus, India never became a dominant player in textiles. In this production-linked incentive scheme, money is not paid for setting up factory. It is paid for manufacturing. The guy who produces more will benefit more. The guy who produces faster will get benefit early. So PLI scheme can create a dominant, incentive for manufacturers, especially on export oriented. And today, when we are looking to invest in companies, we are definitely checking, are they trying to become part of PLI? What are their plans of becoming part of global supply chain management? And I believe, like chemical sector, companies using PLI to become part of global supply chain management will be able to create value for shareholders.
Interesting. Mr. Shah, just one quick thing. So I get your answer. Why would you believe some people are saying that the PLI schemes are great for 5 years, but they will not end up making globally competitive companies, because once the PLI benefits are taken away, they will not be able to compete with the global behemoths? Why is this doubt coming across?
Because when they were kids, they started just running. They were never guided by their parents holding hands to start walking. They, like Niraj bhai, I was a normal kid. When I started growing, I had to handhold my mother, father, and start walking. And today, without their handholding, I'm able to walk. But these critics are the people who started running right from the day they were born. They were never handholded.
Okay, very cool. I have one more follow-up question to that answer, and on chemicals, right? So many, there are, the valuations are right. But I'm not really talking about stock picking out here. I'm talking about the runway for growth, because there are a bunch of people who believe that the specialty chemical companies have done a fair bit of their growth. Sorry, I'm also talking about the stock picking or the investing bit out here. And then there is a camp which believes that even though these stocks have run up, and even though they've performed really well over the last 5 years, both fundamentally and on the stock price bit, the runway for growth is so long that it will be wrong to call this a long pause. This is probably a temporary pause before which their performance and eventually the returns start again. Do you have any thoughts here?
So undoubtedly, I believe chemical companies will continue to do well in terms of operations. Most of the chemical companies are expanding capacity, and that expanded capacity will get utilized, resulting into higher sales and hopefully better margin and higher profitability. But at the same time, market has also become fairly bullish about discounting these prospects. So could there be a temporary pause because markets are discounting all the positive things about chemical companies? Answer is undoubtedly yes. And will all chemical companies do well? Answer is undoubtedly no. There will be, like in technology companies which will be able to reinvent themselves. From body shopping, they move to application maintenance, infrastructure support, and then they moved into digital products. Same way, chemical companies will also have to move from just niche and specialty chemicals to more focused chemical products. They'll have to take care of pollution. They'll have to follow safe manufacturing practices at a much higher level than what they are following today. And not all chemical companies will be able to do this transition.
No, that's true. And we're already seeing evidence of that play out in some companies for sure. Mr. Shah, one more belief is that this, the call it a reflation trade or whatever, but the way things are set up, there is a belief that the time to be in real assets is now. So bonds might be a no-no, but all forms of other real estate, real assets, real estate, equities, even hard commodities, this is the time to be in them. We've spoken about equities. What about the other assets, commodities, maybe real estate? What are your thoughts there?
So on the real estate, again, Niraj bhai, we are very bullish. We believe over last 10, 12 years, real estate sector's contribution to GDP has almost come down by half as housing prices had become unaffordable. Developers were kicking consumers as a football. And now stars are aligning for real estate sector's improvement. Work from home has ensured that all of us are short of one room. Interest rate on housing loans have declined to 6.75%, 7%. Today, most states in which we are staying are borrowing at a higher rate than that. So citizens of a state are borrowing at a rate on housing loan cheaper than the state on borrowing cost. Third, affordability has improved for certain set of people as they are not spending money on traveling, entertainment, and other stuff. And most importantly, with RERA, now consumers can no longer be kicked like a football. You have to respect consumer. All this thing will result into expansion of housing, and many state governments, including Maharashtra government, has given temporary stamp duty concession that has also preponed purchases. So my feeling is that real estate sector will continue to do well for a couple of years to come. And from mid-single digit contribution to GDP, they will probably go into low double-digit contribution to GDP. Now, the real question which arises, how do you play this theme? One theme is to go and buy direct real estate. But as you know, real estate is all about location, location, location. Maybe the flat which you buy will not appreciate in value, and the next door flat will start appreciating. So direct real estate obviously is fairly large amount as well as prone to location risk. If you go and buy real estate developer stocks, governance issue does come into play. There are very few listed companies which are worthy of investing. So we are actually trying to play this theme through home improvement, where we are investing into cement sector, tiles, paints, furniture fittings, plywoods, electrical fittings, consumer durables. These are the segments which we believe will give us a ride on the real estate theme and where governance will be acceptable to our standards.
And what about commodities, Mr. Shah? Hard commodities?
Niraj, commodities is always difficult to say. When steel prices were where they were 6 months ago, did we have a view that they will rise so much rapidly? Answer is no. Iron ore prices went up 10% in a single day, few days back. Did we have a view that that will happen? Answer is no. We believe commodity is a cycle. When prices rise, new capacity starts coming into play. People find alternate materials to reduce the demand. And over a period of time, demand comes down, supply increases, and hence prices starts falling down. And the same cycle happens in a reverse way, where at lower prices, capacity is shut down, more alternate demand emerges, and the commodities make a bottom. So when you're investing in commodities, you have to figure out where we are in the cycle. Now, people can say that this is a super commodity cycle, but I believe commodities is still in a cycle. At current level, they are at above their fair value. And through this mechanism of more capacities coming into play and alternate materials being used, we will see commodity prices softening over a period of time. The current momentum does seem to be in favor of higher commodity prices, as reflected in global fund managers' survey of higher inflation. But is it like sustainable thing? Answer is no. At some point of time, commodities will make a top.
Fair call. Mr. Shah, this is lovely. We can go on and on, but this was just lovely to talk to you on a variety of things. And we thank you for that. And thank you for taking the time out and speaking to us today on Talking Point.
Thank you.
And viewers, thanks for tuning into this edition.